home builders have been a red-hot trade for investors this year. But could the builder boom go bust? Here's Diane Olick with your 2020 housing playbook.
The housing market is a mix of highs and lows, so here's what to watch in 2020. First, the housing shortage will get worse. The number of homes for sale is already low, and demand is incredibly strong thanks to improving employment and the largest generation aging into its home buying years. The demand, however, is mostly on the low end, where supply is leanest. That will cause prices to continue to overheat at the entry level, while prices ease on the higher end, where supply is more plentiful. Second, mortgage rates will stay low. Mortgage rates dropped in 2019 and will likely stay low through 2020 as uncertainty over a trade war and presidential election year keep investors heavy in the bond market. Mortgage rates loosely follow the yield on the 10-year Treasury. The only wild card is mortgage finance reform. If major changes are made to the roles of Fannie and Freddie, rates could finally break higher. And third, we're bullish on the builders. The combination of a major housing shortage and low interest rates will keep demand for new housing high, both single and multifamily. The home builders have been ramping up production, and in 2019, they finally started to pivot to entry-level homes. If they can afford to put up even more, big sales numbers will follow. Their headwinds, though, continue to be high prices for land, labor, and regulatory compliance.
That, of course, was Diane Olick reporting. Check out some of the best performing home builders in 2019. Masco, they're not a home builder, but they build the faucets and stuff that go into the houses. You got names like D.R. Horton, Pulte, and Lennar. They are actual home builders. You had M.I., we talked about, the one in Columbus, Ohio. So will the home builder rally continue into next year, Victoria?
Yes, I think it will. We own Lennar. It's in our portfolio. We think there's a lot of strength going forward with mortgage rates this low and with the momentum that we're seeing with the consumer. We think housing play has some room to go.
So affordability definitely helps that, too, because you have the accommodative Fed, as you mentioned earlier. Housing affordability is as affordable as we've seen. And we have had a shortage of inventory. D.R. Horton has actually benefited from that in particular. And I think that you're going to continue to see a sort of catch up in that space.
You know, you're in L.A.
Yes.
I mean, there's no housing affordability there. We know you got to move out to Victorville to get a house that most people can afford. You know, we always talk about these big markets. Tim, is there any stock? I know you got your fast pitch coming up in a second, but is there any stock place like Bristol, Virginia? You know, off the radar places. We always talk about the big money of New York. That's not how you make the big money.
Well, I just want to point out that I think the macro, you know, one of the things you say in a lot of different investment constructs is you can't invest in a bad neighborhood. So literally bringing this into the housing space, I think rates are going higher in 2020. I don't think this is going to be good for housing stocks. They're totally correlated to the rates market. I would say 2/3 of your return was correlation and beta related to lower rates in 2019.
Well, I don't think they're going to go higher, though. I think they're going to go sideways. I think 2020 is actually going to be a weak year.
I think, I don't think rates are going to 3.5, but I do think that rates are the trend is higher. We just talked about a bunch of trades that are reflation trades. I mean, that's a higher rate environment. I don't think housing stocks can outperform it.
Well, just overlay the 30-year mortgage over the last couple of years. You look at it, it obviously went from 4.8 a year ago down to 3.8 where it is right now. And if you do the new home sales, you overlay that, we're right now at like almost 10-year highs. And back a year ago when they were at 4.8, which was a 10-year high almost in mortgage rates, they were much lower. So it really is a rate call. I do think it's interesting that the 10-year Treasury is having a lot of trouble here at 2%. But if we get into this period where, you know, you're talking about consumer, you're talking about all this stuff, we get all these headwinds to global growth out of the way, rates are going to have to go higher. I mean, that's exactly what happened in 2000.
That, though, for a
well, no, I don't. Listen, but what I'm saying is,
but if the economy's so strong, folks,
they should be going
back and rates need to go higher.
I'm just saying, 2 years ago, everybody on CNBC, rates are going to 3%. Next thing you know, we're at 1.5%.